There are 5 levels of crypto wealth, and you're probably stuck at number 1. And in this video, I'm going to explain what each level is, where you're at right now, and what you need to do to move to the next level to build generational wealth. Level number 1, you could probably guess it. You're basically a gambler. This is where almost everyone starts. And unfortunately, it's where a lot of people stay for forever. You've heard about crypto from a friend. Maybe you saw it on TikTok or you watched someone, make a fortune overnight and you thought, I need to get into this. So you threw some money at whatever was pumping that week without doing any real research. There's not really a strategy for when you buy, no plan on when to sell, just hoping that the number goes up and you can cash out before it crashes. Most people enter the crypto space exactly like this, chasing green candles and hoping for the best. It becomes an emotional roller coaster. The gambler buys based on emotion, and the emotion is the worst trading indicator that you could possibly use. They see a coin pumping 50% in a day and think, I need to get into this before it's too late. And so they buy the top, and then it dumps 60% the next day, and then they panic sell because now they've lost all this money and they can't handle watching it go lower. This is a classic buy high, sell low pattern that destroys portfolios over and over again. Also, something else I see often for this group is they're chasing narratives instead of building positions. People in this level are always chasing whatever narrative is hot at the moment. AI coins are pumping, so they sell everything and they dump it all into AI coins. Then meme coins start running, and so they ape into those right before they dump. They're always one step behind whatever the market is doing, and by the time they get in, the move is already over. And they don't manage risk, which is one of the largest problems with this group. They have no concept of position size or portfolio management. There's no structure, no plan, and no way to manage the risks when they inevitably invest in something that goes wrong. So here's why most people stay stuck at this level. They treat crypto like a casino. They throw a little bit of money in, they hope to make a bunch of money in a very short period of time. They're not really investing. And if you go to casino, just like a gambler would, the house usually wins. Most people at this level lose money, not because crypto is a bad investment, but because gambling is just a poor strategy. Some get lucky once and they think they're a genius, and then they give it all back in the next trade chasing the same high. They cycle through the pattern for years, making money in bull markets and then losing it all again in bear markets, waiting for the next crypto cycle to begin. If you've been following this channel, you should be way past this level a long time ago, but I think it's important just for the newcomers in the space to understand where you're starting and where you're going. Level 2, the hodler. Level 2 is a big step up from level 1, and honestly, just getting here puts you ahead of most people in crypto. So what is a hodler? It's, a holder, but the L and the D are swapped. But in general, you've stopped gambling and you're holding these positions. It sounds simple, but it requires more discipline than most people have. You bought XRP or Bitcoin or XDC or ETH, whatever you have, but you've just held it through the volatility. The holder has one core strategy: don't sell. No matter what happens in the short term, don't let your emotions take over, continue to dollar cost average, and eventually you'll make money. This doesn't always work though, because the market does drop 50, 70, or even 80% sometimes if you bought at the highs and you're just holding, waiting for the recovery. Now, over a long enough duration, this will work. The holder understands one big thing that the gambler doesn't, and it's time in the market beats timing the market. They understand that trying to trade in and out of positions ultimately just loses money because you're competing against algorithms and professionals. So they just sit tight, ignore the noise, and let time do the work. And honestly, this is the simplest strategy that works better than most active trading strategies out there. Most people that are trading, 96% of those people lose money because, again, you are trading against professionals and algorithms. So for the average person that has, a day job or other things that they're focused on, this is probably one of the best ways to go about it. The problem with holding, though, is it's not real wealth building strategy, or at least not the most effective one. You're not actually doing anything to grow your position. You're just waiting for the market to do the work for you, which, again, if you want to be passive, is a good way to go about it. Most holders watch their portfolio go up in bull markets and down in bear markets. And over a full cycle, they often end up roughly where they started, maybe slightly down, but they're not compounding their gains in a meaningful way. So what's the missing piece? Well, they don't have an exit plan. Their plan is, I'm never selling, which sounds great, but it's not actually a strategy. Now, if you understand that you're going to be able to borrow against these assets or put them to work to be able to generate cash flow and compound them, it's a different story. But not having diversification, no risk management, and putting full faith that an asset's just going to go up for forever, probably not the best way to go about it. And the problem here also is when you do cash out at some point in the future, if you're not borrowing against it, like we talk about here on this channel, probably going to have a significant amount of taxes that are going to be due. But if you're trading all the time, you're going to have those taxes due anyway. So you want to make sure that, one, you've either structured this in a way like an IRA or another product where the taxes are deferred, or they are, risk tax free if you're in a Roth, or you're doing it inside of a life insurance policy or an endowment or some other structure that mitigates taxes. Or if you are doing it in your personal name, ideally you're going to move it into a trust or an LLC so that you have at least the full breadth tax code at your disposal to be able to offset some of those tax implications that you're going to be incurring when you do inevitably sell a portion of your bag. So how do you actually move move past level 2? Well, you develop an actual strategy beyond just holding forever. And this is when you're starting to think about what you're trying to accomplish with the money. What am I going to use this money for when I hit certain levels? And you want to learn about market cycles and where we are in those cycles so you can make informed decisions instead of just hoping. You're going to also start taking profits at predetermined levels instead of just watching your portfolio go up and down. And then you're going to take those profits and do something else with them to be able to diversify your position, generate cash flow, or trade into other digital assets that will continue to be blue chips and compound over the long term. So you want to start thinking about crypto as part of your overall financial picture, not a completely separate bet that you're making on the side. This level is much better than level 1. You're still missing a big piece of the cake and they will be crushed. So again, this is probably the best position for somebody that is a passive holder that has a strong income and a diversified portfolio. You know, just dollar cost averaging into these positions is a great way to do it, but also having some exit points or at least some way to be able to generate liquidity or cash flow over the long term would be ideal. And that's really where level 3 comes in and you become an investor. So this is where things start to change. This is the first level where you're actively building wealth instead of just hoping for it. So what makes the strategic investor different than the rest of these other levels? Well, the investor doesn't just hold. They have an actual plan that guides their decisions. They know exactly what they own, why they own it, and when they're going to be taking action with those investments. Each position has a purpose. Every buy has a reason and every sell has a predetermined trigger. And this isn't about being smarter than the market. It's just having rules and guidelines that you're going to be able to follow consistently while you're making investments. The investor also understands these market cycles. They accumulate aggressively during bear markets when prices are low and everyone else is scared. You can look at the fear and greed index in crypto. I think we're around 11 right now, still on the fearful side. And then they're going to take profits when we see, you know, substantial greed in the market. That's how you make money. You buy low, sell high, right? Now, this is a simple concept to understand, but it's very difficult to execute emotionally when you're living through those moments. You seem stupid buying when everybody else is selling and scared and thinks it's going to go lower. And you also seem silly whenever all your friends are telling you that it's going to continue to go up, even though you've gone up 4, 5, 10x from where you bought the assets at. It's not easy to execute, but if you've already determined these things and you know where you're going to be putting the capital, or you have a bag that you're going to continue to dollar cost average in that you can leverage later, all of these are exit strategies. You just want to make sure that you understand which one you're using. You also want to make the assets work for you. So if there's a yield strategy to grow your holdings, even when prices aren't moving, like we have at Digital Wealth Partners, you could potentially stake your crypto, which will provide you liquidity. And there's some other ways that you can do it too, right? If it's not an algorithmic trading strategy, it might be staking your assets or providing liquidity in a DeFi pool or earning yield on stable coins during bear markets. Or if you're a bit more sophisticated, you could be selling puts or buying calls to be able to generate premium, making your assets work for you instead of just sitting there doing nothing while you wait for the next bull run. And every percentage point of yield compounds over time. So if you're able to add, 1% XRP a month, or, even if it's 10 basis points of XRP or whatever other digital asset per month, as that asset appreciates, that's going to continue to compound your wealth over the long term. And it all adds up to real money at the end of the full cycle here. And, it gets you closer to your financial goals, whatever those might be. The investor also understands risks, okay? At this level, you actually understand the risks that you're taking with each position. They understand higher yields usually mean higher risk, and they don't chase 50% APY on random protocols. They understand that smart contract risk, counterparty risk, liquidity risk, and the size of their positions matter when they're making allocations. When something goes wrong in crypto, and things will go wrong in crypto, they're not wiped out because they managed their exposure. Again, they could use options or other strategies to be able to hedge the downside risk or accumulate more if the market drops. These are a little bit more sophisticated strategies than most people use, and that's why you want to work with a financial advisor or somebody else that has access to these products. And you often tend to have to be a little bit, higher net worth in order to be able to meet the risk requirements for them. But all that being said, if you are a serious investor and you have a significant allocation in crypto, you should probably reach out to Digital Wealth Partners, and I'm sure they would love to have that conversation with you. And again, this is kind of where people get stuck. You probably understand the market cycles. You probably understand some DeFi. You've been able to participate in it. You understand how to custody your assets and mitigate risk from, leaving it on exchanges, but you're stuck here because you figured out the investing part, but you haven't figured out the wealth building part. There's a difference between growing a portfolio and building generational wealth that transcends all these market cycles. The strategy that gets you to level 3 won't get you to level 4, and that's where most people get stuck. This is where most people stay, at level 3, even if they have all the necessary knowledge, because they don't know what they don't know. And inside the Beyond Broke Mastermind community, we break down what actually takes to keep moving up instead of staying stuck at the same level for years. And if you want to learn more about that community or join it, you just go down to the pinned comment comments below, and we'll see you guys inside. So you've crushed it, you've dollar cost average, you've mitigated risk, you have some option strategies, you're generating premium or compounding your investments. What does the next level look like? Well, that's level 4, and it's the capital allocator. Level 4 is where crypto stops being just an investment and it becomes part of a real wealth strategy that goes beyond portfolio returns. So how do people at this level think? Well, the capital allocator thinks about things that most crypto investors ignore entirely. They're not just trying to grow their portfolio, they're trying to optimize every aspect of their crypto holdings. This includes taxes, legal structures, custody, access to opportunities, and integrations with traditional finance. At this point, you're playing a completely different game than the people that are still arguing about which altcoin is going to pump next. So let's talk about taxes. If you understand taxes at a deeper level, you're going to want to build a strategy around that to minimize your tax burden legally. And this is the difference between this level and all the others. If you're paying 40% or 20% taxes on your gains, those can be life-changing amounts of money depending on how much you've made in the market. On $500,000 gain, that's $100,000 that you're keeping in your pocket instead of giving to the government if you've done this the right way. Using the right structures is super important to be able to accomplish this. Depending on your jurisdiction, this might mean holding crypto in a specific type of account that provides tax advantages. It could mean setting up an LLC or a trust or some other entity entirely to hold your digital assets. It might mean timing when you take gains based on the income that you've had that year in order to stay in a lower tax bracket. Every situation is different, which is why most people don't do this and they just pay whatever taxes they owe because it's simpler. But if you're proactive and you work with the right professionals, all of this is legal. And a lot of people get caught up in tax credits or these other things that they think are good until the IRS comes back around or whatever other, tax authority is governing them depending on this jurisdiction. And then you end up owing penalties, fees, and back taxes. You don't want to be in one of those positions. So you want to work with professionals that understand the tax code in your jurisdiction and they're able to legally and ethically help you mitigate taxes. So once you have the tax part figured out and you had things structured the right way, how do you hold those assets? How do you mitigate the risk of you passing away and having continuity for the next generation or your spouse? If it's on a cold wallet, they don't understand anything about crypto, what does that look like? Well, it's a completely different risk for custody for the average crypto holder. They're not keeping $2 million on a ledger in their sock drawer and hoping nothing goes wrong. They're using institutional custody solutions with proper insurance, security protocols, and backup plans, and designated beneficiaries. They have an advisor. There's multiple layers of security and backup plans to make sure that you're mitigating the risk of loss when you're using the right custody solution. And they're actually thought through. And anybody that's doing this correctly has actually thought through what happens if I were to pass away or I become incapacitated. And they make arrangements before those things happen. Because as a responsible adult, you should be taking these things into consideration. So what does it look like to integrate your crypto portfolio with traditional finance? Well, here in 2026, I think that we're going to see that in real time. We're going to see the tokenization of the stock market and a lot of other financial products. But integrating crypto into traditional finance is key if you are an actual capital allocator or a sophisticated investor. You're going to use crypto as collateral, potentially for loans instead of selling in order to be able to mitigate taxes that way. You might develop relationships with banks or financial institutions that actually understand digital assets. And your crypto holdings are going to be part of your broader financial picture, which might include real estate, equities, bonds, and other assets that you have an allocation to. And again, many people are siloed in crypto because they believe in the promise there. You have to generate the wealth somehow, and there's nothing wrong with that. It also depends on your, risk tolerance, time horizon, many other factors. And again, should work with a financial advisor to help you structure that the right way. But post price appreciation, many people do diversify into these other asset classes for a holistic portfolio with uncorrelated bets in order to be able to mitigate risk and downside when the market inevitably goes through another bear market. In order to do this at scale, you're probably going to need to build a professional team. Like you're going to need good advisors on your side that understand digital assets. The people at this level get professional help instead of trying to figure everything out themselves. And this plays a crucial part. Professionals who actually understand crypto taxation and can find legitimate strategies to be able to reduce your burden. Lawyers that understand digital assets and structures and how they can set things up properly from the start. And financial advisors who can see the full picture and coordinate all of these investments together. Trying to do so all by yourself, it is possible, but most people don't have the time, expertise, or the network in order to do this at scale and do it well. So what does this look like at level 4? Well, you're not just growing your wealth, you're protecting it and optimizing every aspect. You're keeping more of what you made instead of giving it up to the government unnecessarily, and you're accessing opportunities that grow your wealth faster than public markets alone. And you're probably building a foundation for something much bigger, which is what we're going to talk about in level 5. So how do you actually get to level 4? Well, you get serious about tax planning before you actually need to, and not after you've already made giant gains and have a giant tax bill. You want to start building relationships relationships with professionals who understand crypto and can actually help you before your liquidity event. And you want to think about your crypto holdings as part of your total net worth, not just a separate thing that you're gambling on. You also want to start considering structures and strategies that might benefit you specifically based on your situation and start exploring those. And that's what's going to get you, to level 4 and beyond. Level 5, the architect. Level 5 is the final level, and 90% of you that are watching will never get here. And I'm saying that to be mean, it's just the honest truth. If you don't have real professionals to be able to help you and you're not able to take this final step, it's almost impossible to actually get to this point. And it's also a mindset shift. Level 5 isn't just about making money and more, it's about creating wealth that outlasts you. You're creating generational wealth that thinks in decades, not in market cycles or short-term price movements. People at this level are not worried about the next bull run or the next correction. They're thinking about where's crypto going to be in the next 20 or 30 years and positioning themselves and their family to benefit from that. And if you're just dollar cost averaging and holding, that could be the strategy. But it also, you want to understand the risks and the other things we talked about up to this point. And, really at level 4 is when you start putting in structures. You want to have an estate plan for your crypto. And estate planning for your crypto sounds obvious, but almost nobody does it. And it's a huge problem if something were to happen to you. What happens to your crypto when you die? Do your heirs even know it exists? Do they know how to access it? Do they have seed phrases and passwords? And do they know how to get to them? Do they know how to sell it or even move it from one exchange to another? Do they understand the cost basis and the tax bill that they're going to have? All this stuff should be predefined and structured the right way far before that's a problem. And if you have enough money, somewhere north of $20 to $50 million, you might consider family office structures and working with a multifamily office. If you have more than 100 million or 200 million in crypto, then you're probably a single family office. But you're going to apply these principles and you're going to consolidate management of the family assets so that everyone works together instead of being scattered and disorganized. You'll have clear governance on how decisions are going to be made both now and after you're gone. And the education that you're providing is going to be set up so the next gen understands these assets, what they're inheriting, and how not to squander it. One of the biggest pieces that I've seen from extremely wealthy families and a lot of the people that would fall in this group as far as the architect goes is knowledge transfer, which actually matters almost more than the wealth transfer. They have a succession plan for knowledge, not just the assets. How do you pass down lessons you've learned about building and preserving your wealth? How do you make sure that your children or your grandchildren actually understand this space and can manage it responsibly? Giving them the money without transferring this knowledge usually fails within 2 generations because the heirs don't know how to handle it. So you want to be thinking about legacy if you're an architect. What do you actually do with this wealth? And what do you want to accomplish beyond just accumulating more? Is it about providing security for your family for generations to come, paying for their college, their first home, setting up philanthropic organization to be able to affect change for a cause that you feel strongly about? Is it making an impact in the world? And what are you giving the next generation in options or opportunities that they've never had before? All of these things are considerations and topics that we talk with families about when they're setting up a family office with Digital Ascension Group. So level 5, crypto is just one piece of a much larger picture that spans multiple asset classes and multiple generations. It might be a really important piece, but it's integrated with everything else, so it's cohesive in the strategy that you put around it. You might have, again, real estate, businesses, traditional investments, charitable giving, and all of that's working together for a focused goal and purpose. The goal is bigger than just accumulating more crypto or watching the number go up if you're an architect. So why do most people never get here? 90% of people never going to become the architect. Well, very few people in crypto think this way because of just the culture that's generated in meme coins and things that are, a get rich quick scheme. Now, over time, I think that'll change, but that's the perception as it sits today. And most people just stay at level 1 or 2, hoping for a 10x that'll change their life. The ones that build real wealth, lasting wealth, are the ones who zoom out and think longer term. And they see crypto as a tool for building something that matters, not just a lotto ticket. Most people spend years bouncing back and forth between level 1 and 2. They make money, they lose money, they make it again, they lose it again. It's exhausting. And it doesn't build anything that's lasting. The people who actually build wealth in crypto are the ones who keep moving up these levels. They learn, they adapt, they get the help that they need, and they think longer term. And if you're ready to reach level 5, you can go to digitalfamilyoffice.io and we'll help you get everything going and set up the right way. Stay curious and stay ahead of the curve. Until next